We have three of our special guests here that are going to be on the panel. So we have Jeff Turek and Gavin Glazier and Martin McGrath. And we'll go through, we'll do a quick intro on each of them, but we've also got our committee here as well with Julie James, Karen Walmsley and Brett Scallon as well. So welcome everyone. And firstly, just want to throw over to the three special guests. Jeff, are you able to give everyone a bit of a background, a bit about your business, your location and your typical ideal client?
Sure can, thanks Matt. So my business is Everlesco Financial Services. We're based in the CBD in Sydney. We've got 7 advisors and about 20 people in our team. Business in this sort of format has been up and running for about 13 years. Our key clients really fall into 2 segments. The business traditionally focused on professionals and senior executives in their 40s, and that's kind of where we built the business. That was, clients who were 5 years either side of Marshall and my age when we first started the business, was sort of, 30s and 40s. And so for those people, we do really holistic advice. So we do lending and cash flow planning, insurance, super, investments, the whole gamut. And then probably the fastest growing sector of our client base is really that pre-retiree and retiree space, which is, as we've gotten a bit older, our clients have gotten a little bit older. And we've, seen that as an opportunity to grow out that part of the client base as well. And we can talk a little bit more about that, as we go through the day, but that's kind of where we're at the moment.
Brilliant. Gavin, over to you.
Yeah, thanks, Matt. So my business is called Your Wealth Hub Advice, and the business has been around for about 2.5 years. We also have a small license that I run as well. So I straddle my time between running the license and the community we've created, plus the advice business. We're located on the Northern Beaches and straddle our time between here and the city. And predominantly the client base that we've been working with is young accumulators. So we're looking at kind of, people buying their first home, people who are young executives, time poor, that type of space. So that 30 to 45 is where the majority of our clients sit. And through kind of dealing with some of their parents, we've been dealing with a couple of retiree clients as well. So we've got 6 or 7 retiree couples that we work with as well. Starting a business 2.5 years ago in a very interesting time has been quite a challenge, but quite rewarding at the same time, because having almost 20 years in the industry, working on the institutional side, and then across for the last 7 or 8 years in the advice world, it's been able to pick up a lot of things that work really well and apply them in a new business, as opposed to having a large established practice, which I'm well aware of some of the challenges a lot of businesses have as well. So that's our space. We're a small niche play, but that's us in a nutshell.
And I'm guessing you would have met a few people that would have started their business just before the 1987 crash. So you can now resonate with them. Thanks very much, Gav. Martin, give a bit of a background on yourself.
Yeah, sure. So I'm based on the Central Coast, New South Wales, so about an hour and a bit north of Sydney. Business now, financial leadership specialises in retirement space, so pre-retiree, retirees, and everything around that. So background, my business I set up about 5 or 6 years ago. My background is a tax agent, chartered accountant, so I did that for many years, and trust me, it's pretty boring. So at the same time, went and got a master's degree and started doing financial planning about 10 years ago. And when I started my own business, I just didn't buy a book, started exactly from scratch with basically no income. And so tried to be all to everyone and take on any client no matter what was happening. And the business grew pretty fast, pretty quick. And kind of about 2 years ago, went through a bit of a soul search and trying to figure out what do I like doing? Where's my area I want to focus on? Where do I want to grow the business? And basically decided that financial planning was definitely it, specifically the retiree space. And the location I'm at and the kind of the skill set and the type of clients I like working with, I think we do that really well. So we've seen a lot of growth over the last few years on the back of that. Yeah.
Beautiful. Thanks, Martin. Now we'll go back to you, Jeff, back to the start. We've obviously spoken before that your business kind of evolved over the many years, but if you could pinpoint, say, 10 years ago, What was your kind of model and your pricing or the structure like back then?
Sure. I think kind of builds on a bit of what Martin was just saying then. When we started, like many people, you get into the business and you want to help as many people as you can. And we probably took that literally and, you know, tried to provide advice to everybody who walked through the door or everybody we knew. And so, you know, everybody had their own individual plan, everybody had their own individual pricing, and, you know, own individual service offering. And it was, yeah, it was fun. It was, you know, it was an adventure trying to, you know, make that work. And we were a pretty small team at the time. So we had, you know, quite a range of clients and the way we were looking after them. But we made a decision that we wanted to, I guess, build a business and make it a little bit more scalable. You know, noting that no clients want to be scaled. So you still have to have that, you know, individual approach to providing advice, but how do you make that more effective and get some more consistency? We'd also, you know, different to Martin, we bought a couple of smaller books to sort of kick us off. So with that comes, you know, a bit of a range. You can't be as focused on what type of clients, you know, you're looking after. You take them all and do the best you can with all of them. And similarly with some of the, I guess, centres of influence accountants we were working with in the early days, we weren't really clear on what our proposition was. So they would refer us anyone that they thought needed some help for anything they thought we might be able to help with. So that was, you know, kind of the starting point, and you know, it grew and we were able to provide some pretty good service and build a pretty good client base. But as I said, it became fairly inefficient, fairly messy. The risks, you know, to the business were significant as well at that time. So we've slowly but surely evolved. We're probably too slow to evolve it, to be honest. We're still evolving and still working through it. I think part of the challenge of, you know, I guess growing it before we really worked out what we wanted to be was that we didn't want to just, you know, dump our clients and start again. We wanted to keep as many clients as we could and look after them. So we've probably been a little bit slow to bite the bullet in a few areas and evolve the proposition and the pricing model as much as we could. So, you know, now we've got to a place where we're still evolving. We're always learning and taking on new ideas and improving, but we're a bit more confident, or a lot more confident with what we're doing at the moment.
Beautiful. Gavin, over to you. You're obviously a fresh starter. So the question doesn't quite apply to you, but what did you see that didn't sit with you and what did sit with you over your time in your career?
Yeah, I think the one thing that kind of stood out for me when looking at the question beforehand, I've seen a lot of practices try to evolve, similar to kind of what Jeff said, where people kind of starting out and taking on as many people as they can, and they lose sight of kind of what's important to them and what the core offering is to which segment. One of the things in coming into this new business, I want to be really clear that I wanted technology to play a big part in how we engage. You know, for me, you know, getting access to data, really good, reliable, consistent data was really, really important. So from my perspective, I saw different businesses apply the whole cash flow methodology really, really well. I saw some people implement it really poorly, where it was kind of set and forget and surprise, clients weren't engaging. But if you made it, I think the backbone of the source of truth, it got to a point where inevitably it would work and you would have this really, really good data. And over the last 2.5 years, every client that we've had come through has come through using that cash flow data. I won't say which program it is. There's a handful out there. They all do roughly the same thing. But I found by utilizing that, it made the opportunity easier to talk about lots of different things every time we caught up, because you get to monitor what's going on a monthly basis. So for me, having a model that gave me access to good data was important. Having a modular approach to fees. So talking very simply, you know, for us, you know, we charge an ongoing fee that's based on how much work we do. We've worked out how much time it takes us per month to deliver what it is that we need to do based on the costs in the business, etc. So we charge this modular approach. If you're doing cash flow, it's $200. If you're managing someone's super, it's $100. If you're looking at managing you know, a family trust investment portfolio or an SMSF portfolio, you know, it just keeps on ratcheting up based on the engagement. So irrespective of the value of the portfolio, I saw that the cost to serve was largely the same. There were different risks that would apply to it, but having this modular approach meant at the bottom end, some people were probably going to feel a little bit alienated because it looked expensive as opposed to a percentage of asset, but longer term, the asset would grow, but the fee would largely stay within Kui of where it started. It wouldn't be growing exponentially with the asset base. So for me, that's worked really well. The asset-based model, I think, has slowly changed, as I've seen in the advice space for the last 7 years. I think definitely post Royal Commission, there's definitely more focus on fee for service, people understanding their cost to serve, and being able to clearly quantify what it is they do. And I think when it comes to, and I'm going to talk about FDSs and annual fee disclosures and annual service agreements going forward, but I think being really, really clear has put me in good stead, because the conversation at the end of the FDS year is really easy because we've had this engagement the whole time, and they're really clear on what they're getting and going to do going forward.
Brilliant. Thanks, Gavin. Martin, what about you? What was your model previously, and what was your ideal or your typical client?
Yeah, so I think probably there's been 3 stages of pricing modules, and I suppose we'll talk a bit about that today. But probably initial stage before a few years ago, when I was still doing a bit of everything, it was basically just pick a number that I thought sounded right and that the client would be happy to pay, and hadn't really figured out the cost to serve, the rest of it. And I was never in the fee or the percentage base, but always, okay, this sounds about right, $250 a month, whatever that figure is. But it wasn't valuable to the client. It wasn't profitable as it should have been for us, all that kind of stuff. So about 3 or 4 years ago, made a transition across to some more package style options. And so a client would come in, which option do you want? How much work do you want us to do? How many meetings a year? All that kind of stuff, which was a starting point. And that allowed me to significantly increase the fees I was charging, and kind of made that conversation a little bit easier, because it kind of felt like together the client and I were choosing what their fee was going to be across these options. And that worked for a while, for a fair few years, and that helped me increase my fee substantially, probably doubled from that period of time. But then it kind of realised that, as Gavin mentioned there, the modular section is that just because the client picked the middle option, which was 2 reviews a year, all that kind of stuff, I realised there was lots of people who picked that had very different situations. Single people with industry funds versus some with an SMSF and multiple different investments plus assets inside and outside, that what the value they were getting was very different, even though the cost was the same. And so substantially changed that again in the last 6 months, which I suppose, again, we'll talk a bit more about as part of this. And now much more of the modular things, so depending on what they've got going on. Are they single? Are they a couple? Is there an SMSF? Is there not? Are there insurances? And they kind of all add on top of each other in that space as well. So which has also helped us as part of this transitioning of finding what our ideal client is, also makes it clear as to how we're adding value, which makes the conversation much easier with the client as well.
Brilliant. I just want to take a moment here to ask everyone that's watching that if you have any questions for the panel, please feel free to put them in the chat. If you want to be anonymous, please private message for either Julie, Karen, or Brett, preferably not myself, because I'll be sick of talking by the end of it. But if you can just address it to the chat, we will get to them. We're just going to ask a couple more questions these, and then we'll bring up any questions that you may have, just to kind of keep it relevant with the areas that we are discussing. So, so moving on. Jeff, how did you go around reviewing or restructuring your pricing, and did you use any external help to do that?
Yeah, we did. So, I mean, we listened to lots of different ideas, went to lots of different sessions at conferences, AFA conferences, licensee conferences. We engaged a couple of consultants. So one consultant that we worked with for a couple of years was Jim Stackpool. So he had a pretty significant impact on how we approach pricing and our proposition, and where we are now in terms of pricing was a direct result of some of his ideas and how we've adapted those. And I'll talk a little bit more about that. We also got some ideas from conversations with Peloton partners, who I know have done a lot of work in recent years, and added value to a few firms that we know and done a great job there. So we got some ideas from some conversations with them as well. And then when we actually went to put it in place, I guess we probably started from we started from the opposite end of the process that Peloton partners suggest. So we started with new clients and said, if we get really clear on what our proposition and pricing is for new clients, then, you know, we'll build some confidence around that. We'll make sure we're adding value and that's, you know, attractive to new clients coming on board. And I guess we were a little bit chicken. We didn't want to sort of, you know, damage the relationship with the existing clients by, you know, trying something new first. And that's, you know, that has been, I guess, maybe meant that we've gone a little bit slower to get to where we are now. But so we got pretty clear on that. And kind of to Martin's point, our approach now is we would call it, I guess, a complexity-based sort of pricing model. So we have couple of segments and there's a starting price for those segments, and then those prices are increased or decreased based on a multitude of factors, such as, you know, how many different entities do they have, are there strategic complexities within their problem, so are their problems bigger or different to, you know, most other people in that segment. You know, we have a behavioural complexity one, so if they're, you know, really super disorganised or hopeless at getting back to you, or, you know, difficult to deal with in various ways. If they're really difficult, we probably won't work with them. But if they're, you know, just a bit quirky in how they want to be dealt with, we have a, you know, behavioural complexity factor. Now that we don't put that in front of clients and show them that they're getting scored, you know, for the behavioural complexity, but that's used behind the scenes to give us a bit of structure to working out the current pricing. And where we got to in terms of, we don't have any really, I guess, tight niches of the types of people we deal with, but what we got to was, we felt that we add the most value when we're giving, yeah, it's a bit of a cliche, holistic advice to somebody. So, and particularly when you're engaging a new client, it's like we spend a lot of time getting to know somebody and really understanding what's important to them and what makes them tick, and we really enjoy that. And we're going to do that regardless of how we end up engaging with them. And that's quite a time-consuming and, you know, I guess, expensive process. So we kind of got to the point that if somebody didn't really want to engage with us on that basis and open up and share, you know, everything that was going on and allow us to help them across the spectrum of things, then they probably weren't the ideal client for us. So we used to do, you know, risk-only advice, or if somebody just needed some help to tidy up their super, we'd do that. But we don't do that anymore, because effectively we'd apply the same process to that. So it would either end up being way too expensive to charge the client what it should be charged at, or we'd do it and it'd cost us, you know, in our profit. So we've kind of got to the point where we only want to deal with clients who want to engage on a holistic basis, and we're pretty clear on, you know, the value. You know, to do that, you've got to obviously demonstrate the value, and we don't want to engage. If we think we can't add value, then we'll tell somebody early on in the piece and say, we're not best suited for you, and these are the reasons why, or maybe come back and see us in a few years, or those types of things. So, you know, we, as I said at the start, we've got a lot of ideas from around the traps and a few consultants, and then we've kind of adapted that over time to suit, I guess, our delivery and our ideal clients and our advisors in our team.
You touched on a point that I will come back to for the next question regarding your process, but outside your holistic style clients, you don't take on any one-offs?
No, well, there's always the exception to the rule, but you know, in the main, no. But you know, if it's a, you know, somebody's mum who just needs something to be helped out on something, or somebody's, you know, child who needs some insurance or something like that, we would look at that. But if it's just, you know, an individual client with no other relationship to the business and they just want a, you know, single piece of advice or product, we'd say no, not the right place to come for that.
Brilliant. Thanks, Jeff. Gav, over to you. In case you've forgotten, how did you go about structuring your pricing? Because you didn't really go through a restructure, you've gone to just structuring it from the ground up. So how did you go around that?
Yeah, so as I said in the last response, it was more what I had seen over the years in working with practices, being on the institutional side, working in an established practice and seeing what had been done in the past. It really gave me the ability to come in with a clean slate and bring on this modular approach and to scale up and scale down based on the complexity of the advice, the types of advice that we're giving, but really kind of stick to that modular price. It was transparent. People have said it's tangible. They understand why they're being charged a certain amount. So I think if you can articulate, it's more likely people are going to take it up. In terms of support and kind of where I kind of validate a lot of those questions, you know, in the license that I work within, you know, we have a community of businesses that come together. We come together quarterly, and we think of different topics throughout the year to kind of delve into. And once a year, you know, in August last year, for instance, we had you know, our value proposition. We all shared what our value proposition is, how we build it, how we establish it, how we price it, and what we're trying to engage on a regular basis. We talked about critical issues like years 2 and 3. We found that at that point there was this almost you know, a slouch in the engagement, because you've done all this kind of heavy lifting up front. What do we do to keep these people engaged on a regular basis? You've already gone through the kind of exciting, sexy stuff to get them on the right page. So we would talk about those things and kind of figure out how we engage longer term than that. So through that kind of community of 10 or 12 practices, we've been able to kind of build this best practice model, and we're all implementing this together. So for us, this was a combination of kind of peer-led, a peer-led model, tried and tested, and we've been able to pick out the best parts, and we've been constantly able to adapt and apply changes to that on a regular basis. And by all means, the model that I started with, you know, 2.5 years ago wasn't perfect. And you know, when you're starting out, as Martin says, you know, you kind of anyone with a pulse you want to have a chat to and get things going. But very quickly, that transactional client, you know, becomes a bit of a pain in the ass when you're trying to think about how you're going to engage and give yourself to this person, knowing they're probably going to drop off very soon after. They just want that transactional piece of advice, and it's very cost inefficient to focus on those clients. And I'm similar. If the clients have risk only now, I refer them out to another practice. It's not in my sphere, and I really want, you know, predominantly young professional clients who, you know, see the value in getting that help. And in the last 6 months, the number of clients that have come through who now want to buy a house, they emotionally want to get into the market, and kind of talk them through the pros and cons of that space. The fact that they're paying a retainer based on this list of services, and inbuilt into that is this component around cash flow and coaching and mentoring. You know, they value that because they've got no one else to really bounce off in a non-threatening way. So pricing that in for them is this kind of peace of mind that they've got someone to turn to, someone to talk to. And that's the part they really value the most. It's the hand holding, and, you know, is this a stupid idea or is this a good idea? But either way, they're going to come talk to me first, which is a good outcome. So yeah, so it's been very much peer-led that's got us to this point.
Beautiful. And you mentioned that you actually don't do insurance only as one of your offerings.
Yeah, I refer out to another practice. Absolutely.
Beautiful. Awesome. Thank you. Martin, over to you. What was your model? How did you go around reviewing it, restructuring it, and did you get any external help?
Yeah, so yeah, we always went back to the start and figured out, well, what does our ideal client look like? And spent a fair bit of time trying to figure that out in terms of, well, who do we want to help? How do we help them? And then basically sat down and figured out some characteristics. What age are they? What's their income ideally? What's their asset? If you could paint a picture of that ideal client that you could help the most, what do they look like? And once you kind of know that, well, then we went through, well, how do we actually help this person? If this person walked in today, they existed, what would we do for them? Whether that's getting their super sorted, some contributions, looking after investments, organising all that kind of stuff. And so we could even just tangibly figure out what we do for them. And then a part of that is, well, what value have we added? Whether that's tangible, that we've helped them save tax, reduce fees, set up their investments the right way, all that kind of stuff. But obviously then also those intangible parts along that process. So once we kind of figured out what that ideal client looked like, we then basically built the fee calculator around that kind of person. So what have we done for them? We talk about different levels of complexity. Are they in pension phase? Are they in accumulation? How many entities do they have? How many accounts do they have? Are they in SMSF? So there's 6 or 7 different little levers to come off that to try and figure out how that pricing works. And then basically, well, how much value are we adding to this client? Tangible and intangible, what are the kind of things we're doing for them? And what should our fee be that's still going to add significant value to them, but ideally is covering our time and making a nice profit on the way through. And that's kind of that process we went through to figure that out. So during my journey over the last 2 kind of transitions, to move from the accounting to the advice and then the specialization in retirement, I've used 2 different business coaches over this period of time and have helped me tremendously to make that transition. Without that support and guidance to help me through that from an external point of view, I wouldn't have made the changes that we've made and given us the confidence and accountability, like a client having an advisor, the same for myself having a business coach in that space.
Right. Do you mind mentioning who they might have been?
Yeah, sure. So first, I spent a couple of years working with Steve Salvia, I think an AFA Perth expert, so Blackwing coaching, and he helped me make a big transition and mindset change from where I was trying to be a jack of all trades to hopefully now specialising in one. And then more recently, particularly around the pricing restructure stuff, Slipstream Coaching, based out of Queensland. I've been working with them for 6 or 8 months and kind of helped me take me through their what they refer to as pricing uplift. They've got a process that they take through, and it takes a good 6 to 12 months to work, but it's done in the right way on the right approach. And as kind of the book guy said, the way that we then did that, once we figured that out, rather than going straight to our existing clients and trying to have those hard chats straight away, I can see now, we started with new clients coming on board. We actually tested it with new clients for a couple of months and said, this is how we work, this is our pricing. And at that point, we're getting a 90% conversion rate. And went, okay, these fees are double what we were charging our existing clients, and this is working. Now is the time to go and have those chats with some of our existing clients and transition them across as well.
Brilliant. Thank you, Martin. Now, before we go to the next one, just want to check in with Julie at the question desk. Over to you, Julie. Do we have any?
Yeah, we did have one, which was, and it was when Jeff was talking actually, but I think you kind of covered this off, but you might want to speak to it just slightly more, Jeff. Do you think insurance-only clients, and how do you judge? Is it fee for service or a combination of upfront and trail?
Yeah. So, I mean, we do still at the moment have insurance-only clients on our book, and we still look after them to the best of our ability. We do that just on commission basis. We still write a fair bit of insurance, but that's as part of the holistic advice that we give, and we do that and we take the insurance commission for that as well. We've dabbled with kind of, discounting commission and charging fees and that sort of thing, but we couldn't make it work effectively. We didn't think for clients, and clients, as we asked them when we were going through that sort of, I guess, dabbling phase, said they're happy for us to receive the commission when that was put in place. So we still do that, but for new insurance only clients, we would refer them out as well.
Beautiful. Julie, any others?
Yeah. Do all three of you have minimum annual service fees and minimum initial or SOA fees? And if so, are you happy to share these numbers with us?
Go first again, Jeff.
Yeah, we do. So they're different. We've got, I guess, the two sort of key segments. We call it growing segment, which is the wealth accumulators. So minimum annual service fee there is $4,000 plus GST. Initial fees, typically the way we do it is we have what we call internally we call a commitment fee. So that's before we start to prepare a statement of advice, we'll quote the fees and get them to sign off on the terms of engagement, and they'll pay a commitment fee of $1,100. And then there's an implementation fee, and the minimum for a client in that segment is $5,500 for initial advice. And then, there's the complexity sort of scale that increases that. For clients in the retiree space, the initial is pretty similar, and the ongoing is a minimum of $6,600.
For us,
Gavin.
in the accumulator space, the minimum fee is 3.3 because of the GST for the strategy, and that's typically cash flow analysis. Insurance, we still take commission. Super review, perhaps an investment account or some kind of savings strategy that sits on the side as well. So that's kind of wrapped up into that 3.3. That's all pitched into the letter of engagement that they sign off, and they'll pay the letter of engagement for the SOA. Irrespective, that's always paid up front before we start the work. And then the ongoing for that level is $330 per month, inclusive of the GST. So it's just shy of $4,000 per year. And then depending on the complexity, it scales up from there. So again, modular approach, it's an extra $100 per month for, someone's got, if there's a couple of super funds for 2 people, a couple, or if there's a self-managed super fund or a family trust investment strategy or other areas of expertise that they may need some help in. Some clients just like modeling out a whole bunch of different scenarios regularly so they can figure out what they want, and they take great pride and joy in understanding all the numbers off the back of it. Not my ideal client, but there are some people who do like that. So again, it's about ongoing. What do they want? What do they need help in? How we can help them. At the heart of everything, that $200 per month is the cash flow coaching piece that's at the heart of everything. So that's the bare minimum for someone who's just starting out.
Brilliant. And Martin?
Yeah, so yes, this is a short answer. There's not a number. We're less packages now, and we're just everyone's retiree, so most basically in that space. So we use our same modular pricing to, once we figure out what that client's ongoing is going to look like, that effectively becomes their SOA's fee. So, for example, if it's a single person, we're going to have 1 meeting a year. We know they might have an industry fund. We're giving them strategy advice. Then probably about 3 or 4 components added together. That's probably starting about $4,000 a year. So their ongoing would probably be a bare minimum $350 to $400 a month, and their SOA fee would be $4,000 plus GST potentially. So it works out from there. The average fee is about $7,500 to $8,000. So there's a big range in there. There's some that are a lot more, and that's their SOA fee, and then that will be, so your SOA fee is $7,500, and then your ongoing is $700 a month, kind of thing, in that space.
Okay, brilliant. Back to Julie. Any others?
There are. Do you have minimum fees that below which you'd rather turn away the client?
Yeah, pretty similar to that ongoing that we just spoke about. So, and I think it's, for us, I guess it's as much about what we can add value to, and because we want to engage on a more holistic basis, we don't think we can add value properly without charging that level of minimum fee. So typically, I think most people, if we couldn't justify seeing them and adding value at that level, it would be because they didn't need that holistic advice. They just had a single thing they wanted to address, or it was more limited scope that may not be right for us.
Yeah, the minimum fee is interesting. As we said, when I first started, there were some clients who came on who did want to work in a transactional base, and I think of late there's more clients that are talking about, look, can we catch up once a year? Can we do a full review? I'm not comfortable in paying an ongoing, and it's not that I don't value the cash flow and the coaching and the support. It's more that they see more value in being able to come to me once a year, see the whole scenario, be reviewed at that point, and then provide a new statement of advice based on the new position that they're sitting in. So I've just started a new model where at a minimum of $2,000, people can get a new statement of advice based on the existing scenario with some tweaks and perhaps if things have changed. And again, that's very new. So it's only just being tested out. So there's no ongoing service, and it will just be a one-off meeting per year. This is what you will take on.
Yeah, from my side, there's not so much a minimum threshold, etc. The question is similar to what Jeff said: is am I adding value? So if someone comes and meets and they need a year away from retirement, they need some help, but they've still got a mortgage, they need some pension stuff. Unfortunately, I know it's going to cost me $3,000 or $4,000 to do that advice, and I'll take them through that. But I'll kind of say I'm not confident I can add $3,000 or $4,000 back in your situation. I'll try and refer you out. Maybe go back to your industry fund, find some other solutions that can help them at a lower cost. Because unless I'm confident I'm adding the value, I'm not comfortable charging that fee.
Brilliant. Julie.
If I'm currently a risk-only advisor, which string would you recommend that I add to my bow?
Oof, that's a good question.
I'm really glad I'm not on the panel.
Feel free to answer that, Matt. You're welcome to. Yeah, maybe a bit of a cop out. Maybe mortgage broking might be something worth pursuing. I certainly think we do mortgage broking internally, and that's an area of our business which we see as adding a lot of value, because there's a lot of I guess bad advice in that space, which has a big impact on people's cash flow and on their ability to achieve their financial goals. I think risk advice and debt kind of work pretty well together. So that'd be something that you might want to think about as an opportunity, and whether you do that by partnering with somebody who's already got an existing book in that space, you can work closely with them, or kick off from scratch is a bit more challenging. But if you've got an existing client base, there probably are some opportunities in there.
Good answer.
Yeah, I think the business owner space I think risk of business insurance is still something that's kind of underplayed. And I think there's a big opportunity there. And I think at a business level, there is an opportunity for a fee for service engagement for the strategy work that sits alongside with what's being actually done. So irrespective of the strategy that's unfolding, you're probably going to be working with an accountant, a solicitor, or something like that, where you're having a meaningful conversation, you're drilling into the financials pretty deeply. I think fine-tuning yourself to work in that space presents opportunities in itself. So my suggestion would be really kind of gravitate towards those business principles and understand their needs outside of insurance as well. And I think naturally the conversation will flow into a different area through your network, perhaps, or through people you can join the dots and help them in other ways, perhaps. But similar to what Jeff said as well, there's other value-add opportunities there. But I don't think risk is dead. I think it's just going to become highly specialised, and you're going to need the right model to move forward. And naturally, gravitating towards that specialised space in that end of the market is naturally going to pay dividends for you.
Very good, Martin.
Yeah, I suppose something that complements, which is exactly what both the guys have said, but also I think something that you enjoy doing. I mean, there's no point going, all right, well, I should do super with insurance if you don't really enjoy super and the investments and the contributions and the strategies around that. But like just Gavin said, like if that's what you really enjoy, I think you can still build a really sort of solid business around that. You need to use technology and maybe get the right space in there, but I would be afraid of niching out and just specialising in that space. Just make sure that the business can be built with that is going to be your focus.
Fantastic. And I just want to mention there's obviously one of the answers in the chat was from John Jones, who says that estate planning is also another option to tie in with the insurance only. So I thought that was worthy of a mention. We might just stop the questions there. We'll move on, but we will if we get a lot. We are getting a fair few questions that I can see in the public chat, but I'm not sure how many more Julie has that are anonymous. But if we don't get to all of them, I'm sure the panel will be happy to try and provide some answers to those questions offline, and we can obviously come back to that. But we'll move on. The next question follows the previous one, which was about 20 minutes ago, by the way, in case you're wondering. This is going well. How is this process of going through the restructure, or the structure in your case, Gav, in designing the structure for your ideal client, and also how has it changed your business?
Yep. Do you want me to go first again, Matt?
Yep.
So for me, it changed a lot. I mean, as I said at the start, we really started focusing on those clients who are sort of mid-30s through to 40s now, still focusing on those clients in their 40s. But so the main focus for us became about that holistic advice proposition as opposed to the single piece of advice. One other area where we did move away from was those clients who were, probably younger, more getting started type of clients. We really worked hard at trying to make that work because we had a few younger advisors in the business who were keen to sort of, help their cohort. And I think where we ended up getting to was we had a process which we felt worked pretty well, and we were applying that across the business, but it didn't work well for that client segment. And it was too expensive a process for that client segment. And we tried to, chop and change it and make it work so we could bring on more clients in that area. But we couldn't make it work. So we had to make a tough decision and kind of say, well, we're going to move away from that area. If those clients come to us, if they get referred to us, we might be able to have an initial conversation with them and then point them in the right direction of some, I guess some self-help, some guides, or to somebody else we know who specialises or works more in that space. And the other thing that we've done in our business is, as the business has grown a little bit, we've set up, I guess, pods within the business that specialise in those different areas. So we've got teams that, one of the pods focuses on the more wealth accumulators, the other pod focuses more on the pre-retirees, and the other pod focuses on the retirees. So we've built the speciality within the team so that they know how each of the processes work and what the clients might be thinking about. So it allows the business to service a broader demographic, but having the speciality within the team. And that's again been an evolution, because, we all had clients across the spectrum when we first started doing that. So as we've had younger advisors come through, I've been able to hand off some of my clients and focus on, the types of clients I should be seeing, and the other senior advisors have done the same. So that's been a positive evolution. But having that consistent process, the consistent pricing methodology to build on, so that we know that, the younger advisors or the advisors who are coming and picking up those clients are comfortable with the process and the pricing, and it's the right price for the business is important as well.
Brilliant. Good answer. Thank you. Yeah.
Yeah, for me, it was a little bit different, because I tried the best as I could to come in with this idea of the perfect structure, albeit it's been changed and it's constantly evolving piece. One of the piece of information that was given to me a long time ago was, know your value, know your worth. And saying no is quite an empowering experience. And by letting clients know that, as Jeff said, and I think as Martin said as well, sometimes you're just not going to fit every client. And if people get a little bit nervous around price and whatnot, knowing your value, knowing it's going to cost you this amount of money to implement this advice and build the advice, implement the advice, etc. Saying no means that, you're creating a stronger proposition for yourself that's not going to bite you in the backside down the track. So from my perspective, really trying not to waver from that. Yeah, in the beginning, there was a few instances where, probably took on people that was a little bit different. They've become very good clients. Initially, I probably felt a little bit out of my depth, but, studied, researched, and did everything I could to make sure that we're in the right space. It wasn't probably where I wanted to go, but it ended up working quite well. And they've subsequently referred clients along the way. And I'd much rather a book of clients who are engaged, that are quite happy to sign an FDS. And when I call them, they pick up because they value what I do, as opposed to having a book full of policyholders that really don't engage and really make it hard to remain compliant and run a scalable business. So from my perspective, the ideal client and saying no kind of went hand in hand, and really try to stay true to that.
Very good. And Martin?
Yeah, so I think, knowing what your ideal client is makes that, back on what Gavin said, saying no much easier, because you're like, no, now I know who I help and how I help them. And do you fit in this space? No, you don't. So I even had a staff member complimented actually. She said no a lot more in the last 6 months, which is great, because even they're like, why are you taking on these clients that don't fit? We're having to learn these new things or do something different, because it's all customized, and it's obviously not a great business model to run. So what we did, I suppose, when we went in that ideal space, very soon after, we realized that even though the retirement space, I felt, yeah, that's niche, that's what we want to do. We realized within that, there's even still subsections with different types of clients that fit in that space. Is that, are they retiree with the age pension? Are they retiree without the age pension? Because that has an impact on things. And when I say retirees, we still have a fair few pre-retirees, top pre-retirees as well. So there's obviously contribution accumulation strategies we're doing for them that's different to those that are retired versus those that are older age. We're talking about estate planning stuff. So we've actually broken down our niche further down into each of those, and we refer to them as ideal 1, ideal 2, and ideal 3 clients. So we know when the client comes in where they're probably going to sit. Okay, there's an ideal 1, so we're going to need these kind of strategies for them. And we, again, kind of like Jeff said, he's got the hubs of the teams. We're not big enough to have those hubs of the teams, but we kind of know internally what the systems and a couple of staff members that are better at those clients and not as good as those clients. They're all retirees. They all look fairly similar, but at least that kind of extra 10 or 20% helps with those familiarity with those kind of right clients.
Beautiful. Now, the next question will probably apply more to Jeff and Martin than what it would to Gav at what happened to your old clients. But the clients under your existing model, what happened to them?
So with the existing clients, I mean, as I said, we started with kind of refining our pricing and our model with new clients, which was great. And then when we started taking it to the existing clients, there was a couple of different phases to it. So I think one thing that worked out fortuitously for us was we changed license about 4.5 years ago, and that gave us an opportunity to, I guess, change some of the economics of running the business and, the licensing and the product, fees that were potentially being paid to our old licensee, and allowed us to have a bit of a review of platforms and all that sort of thing. So we took the opportunity to tie in some of these conversations with, a review of the product suite and the platform providers and that type of thing, which was great because there was a lot of scenarios where we felt to provide the value that we were providing, we needed to increase our advice fees, but we're able to save them something on the product side of things at the same time. So that was a really nice, symmetry to that conversation to be able to go, so your overall fees are actually about the same, but you're getting this much more value because we're going to roll out some additional services to you that you weren't providing. Or in some cases, it's just you've been getting these services and haven't been paying enough for them over the years. You're going to pay a bit more to us, but pay a bit less to your product provider. Are you okay with that? So those conversations were pretty easy. Most of those were pretty seamless, and that was pretty good timing from our viewpoint. We obviously made a conscious decision we were going to go pretty hard on that in the first couple of years after transitioning. There's still a few that we're working through 4.5 years later, because that's just the reality. But we'll get there. We were also able to look at, we had a pretty big tail of less engaged clients that a couple of the books we bought in the early days. We kind of separated the risk-only clients that we had and treated them as a separate pool of clients. We wanted to keep them. We still try to engage them on more things if we can, and we would love to be able to provide that holistic service offering. But then we had clients who were they used to be members of a corporate super plan that we had, and they'd gone into a personal book and they were paying $2 a month on advice fees or that sort of stuff. So we went through there, we gave them opportunities to engage, and then just said, ultimately, if we don't hear back from you within a month, we're just going to turn your fees off if we can. Some products we could, some products we couldn't, and we're going to remove ourselves as an advisor, but we'd love for you to engage and talk to us about what else we can help you with. We've actually converted more of those to engaged clients than we thought we would, but the vast majority of them we never heard from, and they just sort of disappeared. So that was a great exercise for us to really, in the nicest possible way, tidy up the client base a bit and remove that long tail of clients that they weren't paying us a lot of money, but they didn't need to be paying us anything because they weren't getting any value from what they were paying for. So that was a good exercise to go through at a similar sort of time. And so now we know that we've got about 1,000 family groups that are paying us fees and they're really engaged. And then we've got the risk book, which is separate to that. And we're pretty confident about who we're looking after and what value they're getting and the fees that they're paying. As I said, still a bit of work to be done and a few to be brought up to speed, but we're getting much closer.
Brilliant, thank you.
The only thing I'll add to that, as you say, it's not really my space, but from what I've seen over the years, working with practices and being at various conferences and events, I think one thing that I see that goes astray is when people are changing their model, it's having that belief in yourself that you can deliver and charge a higher fee. And I think a lot of it is mental. I have seen a lot of planners who have gone ahead and tried it, but when they've come to sitting in front of a client, they don't believe that they're worth that much money, and it's very hard for them to get them across the line. So when you ask them, how did it go, and you're kind of touching base and what did they say? Oh, look, it was just too hard. I didn't want to do it. Or the excuses come out, and legitimately there's probably going to be instances where you need to make a tough call and walk away from some clients because it legitimately is costing you more money than you're making on it. That's a hard thing to do, particularly if the client's been with you for some time. And I'm sure there's an option and there's a way of adding value in some way, but from what I've seen, a lot of it has come to belief in actually being able to charge and knowing your worth. And that's been a big stumbling block in itself for some practices, and it's led them to just resign to the fact that this is what I'm going to get, and I'll try it on new clients, and perhaps even new clients. It's been really hard to charge a higher amount because it's just so ingrained that you charge this lesser amount because it's kind of worked and it's always been that way. So yeah, that'd be my observation through the industry on that one.
Yeah, brilliant. Totally agree. Martin.
I think Gab just smashed it that last minute, exactly what you need to listen. And that's exactly the space that I was in. And hence, again, why engage an external consultant or advisor or whatever to help you through that process so that you wouldn't have some of those hard chats and you kind of use that reset point. But having that structure in place and kind of going back to that ideal client, how are we adding value for them? Is this tangible? If this made up client, I can save them whatever it is, 30 grand a year, and I should be able to charge them 10 grand a year. Are they getting value? Yes. Can I do the work for that? Is it profitable? I definitely can. So then that's what we did with this pricing model, and basically then started using our new clients. And I think I said the first 9 out of 10 went ahead at substantially higher fees than what they would have been previously. That built the confidence that, yes, I'm adding value. It gave me the exposure to have those chats with people that didn't have that 5-year relationship that I felt like I was going to hurt. I still want to bring them on as clients, but didn't feel like that was going to have the same impact. And then after that transitioned to existing clients and having those chats and going through that module. So the process I went through is got my existing clients, put them into the new pricing model. So if this client walked in today and they were on this pricing, what would that price look like? And some of those were substantial increases, like 200, 300, 400% increases. And then figured out, is there value to them? What conversation need to be had? And if there is any changes, how does that all work? And basically went through and put yes, no, maybe as to whether they would accept that change if I presented it to them. And did that maths and figured out that even if the no said no and half the maybe said no, it was definitely a still worthwhile process to go through. And I've basically just finished that. I've got 2 next week, but then I'll be finished basically. And what the process or the on track for in terms of figures in my business, I'm just looking at the screen here, is that we'll increase our ongoing fees by about 130,000. I've lost about 30,000 in ongoing fees, but that 30,000 was about 8 or 10 clients. So the net result is basically 100 grand higher in fees while dropping 10 clients. So obviously that is more income, less work, and obviously a much higher fee. So there's definitely some tough conversations to be had, knowing that I was adding value and honestly making sure I was adding value. And some of those no's were, hey, I just don't think I'm adding value at this new fee. I can't keep doing it for the previous fee. Let me find a solution for you that's going to work. And basically transition those clients onto those new fees and transition clients off, effectively off advice at all.
Brilliant. We might throw it over to Julie at the questions desk and see what we got for us.
We have a few. So regarding fees, are they being paid personally, or is it a combination of personal and super? And how often do you tweak your fees?
So for us, it's a combination of personal and super for most clients. We do a formal review at least annually, but to be honest, it happens more often than that because, new client scenario sort of comes across the desk and we have a chat about it amongst the team and say, how should this look and what does this look like and what would the pricing be and does it fit into the calculator? And, you always get ones that's kind of fall just in the cracks of what the standard sort of model is. So, but at least annually we formally review the pricing.
Yeah, and annually as well, most of the fees would index for us. But the majority where I can, I try to pay non-super as opposed to through super. One of the big propositions I talk about is account erosion. for superannuation, and where possible, try to illustrate how that works and the impact of insurance inside of super, fees out of super, and if we're trying to build for retirement savings and create these two streams of investment, I'd much rather than pay in a non-super environment than a super environment.
Yeah, combination as well, probably more out of super than inside. Sometimes if the fee's substantial and there's a lot of work inside, then it'll be split. And so probably I'd say at least half of ours is split, but a lot of outside. And then, yeah, we'll review the fee calculator annually and then make adjustments to clients' fees each year.
Next question. I'm struggling to justify charging an ongoing fee super advice for a young couple in which my mind is a set and forget until a major life milestone, which could be 5 or more years away. Am I missing something?
I think we had some similar experience. Gav touched on it before, that sort of year 2 and 3 wobble, and we had some challenges with that when, in the early days with the younger clients as well. I think it's a reality. I think in some cases, if you can't add value over the period of time, then it's better to admit that and say, look, where you're at the moment and what you're doing is you're on track. We'll be here if you need us, but let's not have a formal engagement for a period of time and give us a shout when you need some more help. I think that's probably the reality of the situation sometimes.
Yeah, I agree. I think understanding, really understanding what they value, the client values, is important, because then if you're meeting them at the same level, they're not going to go anywhere because they identify that perhaps right now there's not a lot to do. But going down the track as they start to accumulate more wealth, or perhaps want to look at different opportunities in the investment property or a non-super investment portfolio, whatever the case may be, there'll be more work. I think by you calling it early, you get so much more kudos and get the chance to retain the client, as opposed to them walking away because they think the fee's the prohibitor in continuing the advice relationship.
Yeah. I think just to add to that as well, we've had circumstances where we've had those conversations with clients and, we've kind of disengaged for a period of time, but they still think that we're their advisor. They still see us as their advisor. And if they have something comes up, they'll still pick up the phone and say, is it okay to ask you, this question, or can we come in for a meeting? And then we have to work out, are we going to re-engage formally, or what are we going to do going forward, and do they need some more help? But I guess, the method that we engage with is really a internal compliance industry function. It's not necessarily what the client is thinking about. They're not thinking about how we engage in our FDS process. They're more thinking about what the useful, relationship and the value is they're getting.
Martin, anything to add?
No, I think the guys done well. No, would I recommend that a young couple needs super advice? Probably not. But as the guy said, if it's more holistic, they need help with insurances, nest investment, cash flow, that kind of stuff, then yes, you can. And that fee should be paid personally out of super. But they definitely don't need specific only advice generally if they're just young accumulators under 40.
Brilliant. What's next, Jules?
For estate planning advice, how do you charge, and what are you charging for apart from referring on to an estate planning lawyer?
It's a tricky one for us. We build the conversation into the holistic plan, so it's built into that overall fee, because we spend a lot of time up front getting to understand what's important to the client and who's important to the client. Often that leads into conversations around legacy or complicated blended family structures or business structures and strategy. So if we're having conversations around unwinding that or understanding that, then that goes into the complexity pricing. And so, we would build that from a pricing model, but then we like to introduce them to a estate planning specialist and make a warm introduction, talk to the solicitor about, what the client's trying to achieve and what we understand as being important to them and why we're having that conversation, so that it becomes a broader strategy around that conversation. So that's how we do it.
Yeah, similar to us, we take a briefing document from the solicitor. We have a couple of solicitors we work with that work at different kind of price points. One's more regional, one's more city-based. And through that, we've got all the data, basically. You know, we use one of the cash flow programs to punch out the data. So we produce a wealth report. Wealth report comes out, accompanies the brief. We'll do a briefing meeting with the solicitor. And then introductory meeting, and then the solicitor takes over from there. So, you know, for me, you know, binding death nominations, having a will, having everything tied up there is, you know, obviously so much better for the client longer term. And if I know they've done that and we've put the will then on the cash flow program storage facility, then we all know where everything is. It's a source of reference. So that will is a critical part, you know, during guardianships, power of attorneys, executors, etc. It's an important part of the estate plan and asset protection down the track.
Yeah, and often we know more about the client's finances than they do by the end. And with the technology and stuff that Gavin's using, then they don't know that this is over here and this is over here. And it's obviously they have to try and relay that to the estate planning specialist. So that's where effectively we step in and help with their transition and making sure their goals are met. And if there's mixed families or the rest of it, then the complexities around that to interpret and overlay the financial side with the legal side.
Brilliant.
How do you articulate the value you're adding in a way that clients justify the fees? Do you position investment management in this, or more intangible benefits?
Both. I think both are important. We talk about in our business empowering our clients to be healthy, wealthy, and happy. And when we started talking about that, we probably went a bit too far on talking about the intangible side of things and the health and happiness stuff. And probably went a little bit away from the tangible. So we've been conscious in recent times to make sure we show that tangible value. So we have a tracking sheet which we use each year when we're doing progress meetings for clients, which shows, you know, where they were when we started working with them. Often I'll have the projections that we had in the SOA to start off with about where they would be and then where they are now. So we show, you know, in each of the different, so that's their, you know, how much they've paid off their mortgage, how much more cash they've got, how their super balance has grown, how their investment, you know, portfolios have grown, investment properties, those types of things, and it tracks the progress on those. So that's a very tangible measure of progress. We also like to, you know, tie those things back to specific goals that they had. So, you know, people don't usually want to have an investment property just for the sake of having an investment property. It's, you know, what are you trying to achieve out of that, or where do you want to get to, and then measure that progress towards, you know, the end goal as well, as to what they're trying to achieve. But then we also ask them questions about, you know, how do they feel about their, you know, retirement preparedness, and how do they feel about their health, and how do they feel about their community, and these types of things. So we are tracking some of the intangibles in that space to link back to that healthy, wealthy, and happy conversation.
For us, Your Wealth Hub advice came from a business called Your Wealth Hub, which is all about education and financial literacy. And the line we use is, you know, ensuring people can make smarter decisions and live the life they want to live. So, you know, we've identified that financial illiteracy is a really big problem. And for us, you know, a lot of our focus is educating and taking the time to you know, give them the basic information, and should they want more, we can give them that information and bring in you know, various reference points to help them understand what it is that they're doing, so they can make a better informed decision about what they're prepared to go into. So for us, it's a lot about being that reference point. We don't profess to be the investment specialist, but we know enough about it and enough about diversification and how their assets should be allocated. And they should know by the end of that conversation why their assets are allocated the way they should be. And you know, we're partnering with good businesses and good firms to help manage that for us. And we work with them to, you know, hold them accountable, so to speak. So for us, it's probably more on the hand-holding side, education, source of truth, and, you know, if something needs to happen, I'll be on the phone straight away to let them know this is what you need to do and this is how we'll manage it, etc. So for us, we're probably pendulum slightly on the other side. I wouldn't say full on the other side of the spectrum, but certainly kind of a little bit left of center when it comes to you know, really nutting through the detail of the investment strategy and underlying assets, etc.
Yeah, I think likewise, I definitely don't see myself as an investment specialist. We actually don't do a lot of that in-house anymore. We outsource it to external people that can do that, Lonsec SMAs and different SMAs in that space to manage that for clients. I think our job's more about sitting in front of the client and getting to know them and understand that as well. And then in terms of the tangible, intangible, fortunately in the retiree space, a lot of the stuff that I can help them do is tangible. If it's contributions and catch-up contributions and structuring their assets the right way, that there might be some tangible tax savings to be had. But a large part of it, I think, particularly over the long term in that year 2, year 3, a 10-year arrangement is all the intangible stuff, knowing that they've got someone outside of their own little family unit to be able to bounce ideas off or pick up the phone with, all that kind of stuff.
A question around grandfather commissions ceasing, obviously losing income. Still got clients high net worth with ongoing advice, but getting back on the books is taking considerable amount of time. Are there any suggestions on how to engage them electronically with a request for ongoing advice fees reinstatement?
No, don't. I don't know. I mean, we had some a little bit of grandfather commission in our business. We worked pretty hard to try and get that sorted out last year, but didn't get it all done. Yeah, there were some clients that have now, still on our books, on old legacy products that are no longer paying us fees, and we're just trying to get them on the phone and have a chat and see whether they want to keep engaging. At some point in time, we'll have to make a call on that. But no, we haven't come up with a silver bullet from a technology viewpoint.
I think it is a hard one. I think the question that needs to be asked is, are these people the clients that you want longer term, and do they value what you do at the moment? If it's a situation that the clients are pretty distant and they're not looking to engage, and you think it's going to take 12 months to come back on the books, there's probably a bigger hurdle that needs to be overcome before you can expect them to sign their life away and jump back on into the business. As kind of harsh as that sounds, it's the reality of kind of that client engagement process. People will value and be happy to pay a fee should they see value, and if there's no value, there's obviously an issue with the fee. So I think that kind of proverb kind of rings true in that instance. From the old Your Wealth Hub business around education, we used to do a lot of work with corporate super clients, and we did a lot of work with education programs trying to engage and take the thin edge of the wedge approach. Get in, give people enough information to be dangerous, to ask questions. Once they ask questions, it leads to unopening doors about their own personal situation, and it's a long process. It takes time to get people to trust you, to part with their cash if they haven't had a real advice relationship in the past. So in that kind of dormant client space or policyholder environment, it's bloody hard to get that across. And I've seen that firsthand, how that impacts, and it does take time to get people curious enough to want to engage and talk to you. But in that instance, as Jeff said, there's no silver bullet. It's hard work. But the question is this the type of client that you want with you if they're not valuing you at the moment?
Yeah, I can't add much for. I think the guys have done it. I don't have many that fall in that space, so I haven't had to worry about it too much. But I agree that it's obviously a conversation that needs to be had. If the client sees value, then they'll be happy to pay a fee. So be confident and figure out what that value is and be able to portray that. Then that conversation will go well. And if it isn't, then there's not enough value there that the client can see. But also, I suppose even a business coach said to me once is that I need to be confident the value is there, because often the client won't know if there's value there or not. Now, I need to be able to help them with that, but sometimes two clients, the exact same situation, exact same fees, some clients might be very happy to pay it and some might not. There is still a personal preference in there. Do I want and do I need a financial advisor, or am I happy just letting things tick along?
Considering the impending annual agreements legislation, have you considered changing your service levels and or pricing due to the annual agreement
No, we haven't. We've been working on, particularly for new clients coming on, and on making sure they understand that we engage on an annual basis, and our fees will be reviewed on an annual basis, and we'll look back at what we achieved over the last 12 months, and then what do we need to do over the next 12 months to maximise the likelihood they're going to be on track to achieve their goals, and we set the pricing based on that. So a lot of our clients currently, they're on ongoing service agreements, so they're not renewing annually, but the conversation about fees is had annually. So if we have to tweak anything in that regard, it won't be a big step, which is great. Something we've been working on for a little while, and we have other clients who are on annual service agreements already, and that renews every 12 months. So we don't think the process is we've got it. It's manual at the back end, but it's pretty technology driven at the front end. So it's not going to get any more expensive really to run it annually rather than every 2 years from an opt-in viewpoint. So that doesn't need to be factored in from our side from a pricing viewpoint. I don't think at the moment, but I reserve the right to change my mind in 6 months' time.
This is recorded, Jeff, so we will be referring you back to this.
Much the same for me, but again, being a new business, I think for me, I'm looking at that kind of client engagement lag point, that 2 to 3 years coming up for particularly clients from last year and the back half of the first year. We're getting to that point where we're going through business as usual. We're starting off a new process of ongoing service agreements, and albeit I feel that clients are engaged and we're really ticking the boxes, I think that natural kind of 2 to 3 year mark is something that I'm going to have to focus on and work on what that proposition is going forward. And that's where that kind of $2,000 fee per year for annual review may come in as a backup. If clients say, look, you've done a great job to date, but over the next 12 months, there's not a lot there for us. How about we just review in 12 months? So that's why I'm considering bringing that in. And in that kind of alleviates some pressure because there's no ongoing service agreement. It's just an annual review that we would kind of work through at that particular point in time. So it's a different formula. It will probably end up reducing the overall fees for a particular kind of cohort of clients, but it may mean that we're kind of engaged for longer and so forth. So it'll just change the dynamic. So I'm trying to preempt that at the moment with this all starting kind of July 1.
Yeah, we've been annual agreements from when I started the business 4 or 5 years ago. So I don't think that change or transition will impact too much, other than the name of the form of the paperwork that seems to change every few years, and that's going to happen. But I don't see that being too much of an impact for us the way that we've set things up.
What modelling tools are you guys all using for modelling your cash flow and scenarios?
So mostly Xplan. So for writing our plans and putting together the overall scenario, we do use My Prosperity for as a wealth portal and hub for clients. And if we have clients that want to go into a deep dive on the cash flow, we use that as the tool to collect that data.
Yeah, we use Midwinter for our modelling, and there's a new goals module that they've just started, which works quite well live with clients that I've been using over the last 3 months since it started, which is quite good. And also My Prosperity, I use that religiously with every client. I think for me, it's probably the best and gives the best deep dive across all the data for my liking anyway.
Yeah, and for us, it's Xplan as well. It's doing the job as it needs to for now. Might consider that changes in the future, but for now, that's what we're using, and it's doing pretty well for what we needed to do.
This one's a double banger. We can drag into the afternoon. So where you've got younger or less experienced planners, do they have a lower charge out rate? And let me just find it. And what do you believe is the sweet spot for the number of clients a planner can service?
The younger advisors, but no, they don't have a lower charge out rate. We have a consistent fee model. And the way we approach that is that it's a team approach. There's a team, there's the support, there's the IP that goes into the process, there's, the process and the solutions we've developed and strategies that we've worked on over many years, which have been delivered by somebody in the role. Where it probably is a little bit different is if it's a highly complex scenario or a client who's got some additional complexity, then a more senior advisor would typically get involved in that situation. And because we've got a complexity-based pricing model, then that client would pay more fees, which would cover the cost of those who need to get involved. But otherwise, it's a consistent pricing, and that's I think it's a two-pronged sort of thing. It's because we know that's what it costs to deliver and provide the advice, but it also supports the younger advisors as they come through to have that conversation and know, well, this is the price that people are willing to pay, and there's no reason they shouldn't pay it to you. And so it helps to build their confidence as well. In terms of how many clients an advisor should service, I think that really is it's a depends answer. It depends what your service proposition is. It depends, what technology you've got to support the clients. It depends on the breadth of advice and the complexity of the advice that you're providing, and the support that you've got within the team to back it up. So, as our business has grown, we've slowly and surely been building out the support that each of our advisors have. They don't thank me for it, to be honest. They're still busy as ever and think that they need more support, and but that's okay. But so that should allow them. And if we're delivering advice to ideal clients using the process which we know is tried and tested, then we should be able to see more clients than we may have been able to per advisor when we first started the business.
Yeah, I think Jeff's right. How long's a piece of string when it comes to what you're delivering? And I think some businesses really focus on that hands-on, high touch, and they charge accordingly, understanding their cost to serve. And obviously there's only so much you can have, only so many hours you can see clients in a day. So I think based on that scenario, if you look at the algorithm, it depends on what you're delivering. Kind of the set and forget model or the annual review model, is far easier to manage, but there's a lot of work you need to do at the end of the year, as opposed to the ongoing cash flow, short, sharp meetings where you can, have a meaningful impact by catching up, an hour per month or 45 minutes per month and get in and get out, that type of thing. There's far less ongoing work that you need to do. So yeah, how long's a piece of string? I've always thought kind of 60 to 70 couples is a really good number. But again, that's based on my model. And depending on, how much I'm charging, if I'm charging anywhere from $4 to $8 grand per annum, for me, that fits nicely where I can pay the support staff. A lot of my support staff are offshore. So it's far more efficient for me to run that model where we are doing a lot of cash flow work and a lot of kind of work behind the scenes to generate reports and ongoing engagement activities. So the cost to serve is lower, but it's still still moving to a point where we're almost getting to capacity. And I know what that capacity point looks like for me, because my model is unique to me, and I know where I have to draw the line. It's just not going to work after that.
Yeah, and I agree with not charging a lower rate for a younger advisor, because like Jeff, I think it's all about, it's the business giving the advice as a group, and it's the systems and the processes that the client's paying for in the end, not just the person sitting across the desk. Obviously, they wouldn't be if they weren't qualified to do so. So yeah, our fees don't change depending on what the moment. If I'm the predominant advisor, there's another advisor on their way, but the fees won't change when he sits in front of clients, because it's the fees for the firm. The number of clients is interesting, and I think that's evolving and changing. I think the number's coming down, but again, it's about the type of advice you give and the support systems you've got behind the scenes. So if it was just myself as the advisor in my business, I think that number for me is somewhere in around that 80, maybe up to 100 range, with the right support staff behind the scenes for the type of advice that we're trying to give to the clients we're working with.
Very good. I'm just going to jump in and ask one last round of a quick answer, because we've gone over an hour and 20. I think this has been excellent. You guys have been giving a lot of good information out there. What is your best tip to the advisors out here watching, if they were going to go down the path of going through the process of looking at their pricing model and their servicing, what's your one best tip?
Can I have two? I'm going to have two anyway.
Go for it.
So I think the first one comes back to what Martin and Gavin both said before: is have confidence in yourself. So get really clear on your value, who you enjoy working with, what you can do for those clients, why you're doing it, and then back yourself to, you know, provide that value and be paid accordingly. And the second one is, I've learnt this through, you know, lots of trial and error and hard work, is just work out, if you're going to look at reviewing your existing client base and the pricing and the service proposition to them, be realistic about, you know, how long it's going to take and the results you're going to get, because you've got to keep running a business whilst you're doing that. So it's not like you can put everything else on hold and just make that happen. And I think to do justice to a review like that, I think it's better done face to face. So you might want to do it over, you know, if you've got a review schedule, you know, do it as part of that review schedule. So it might take you, you know, 12 or 18 months to get in front of everybody and have that conversation. So, yeah, I mean, set some realistic boundaries and timeframes, because, you know, commercial reality is you've got to keep the lights on whilst you're doing this and have other things to do as well.
From my perspective, I approached my new business as, well, what did I want to do? And I had the ability to come in with a clean slate. And it's hard. It's hard work coming in with nothing. But you know, talking to other practices who are looking to evolve and whatnot, I give the same advice. I always say, if you could start again tomorrow, what would your business look like? And then work backwards and try to understand the reasons you're not doing it. You know, what are the roadblocks? Try to dismantle either the mental kind of roadblocks, the physical roadblocks, the financial roadblocks, to understand why you can't do it. I think by attacking the reasons why you can't, you'll very quickly start to build a roadmap on how you can. And for every roadblock you come up with, it's just an opportunity for you to make a better, stronger business. So it's not going to happen overnight. It's not going to happen you know, anytime soon if you don't commit to it. But back to one of the points before, you know, believing in yourself and backing yourself that you can. You've obviously created a successful business today. It's just changing tact and doing things a little bit differently. But and one of the good things about being in the AFA, there's a lot of room for support. There's a lot of tools around you. And everyone, in my experience in dealing with the AFA for the last 15 years, has always been, everyone's very ready to share. So these types of forums, you'll get, you know, a wealth of information. If it's not from me, it's the other two far smarter guys either side of me that will help you out. But that's my thoughts. I just want to add one more thing. There was one question before, or one note before, about the risk environment, you know, whether risk is dead and whatnot. And I mentioned there about the business insurance space. If you haven't seen Russell Collins' book, Skills That Succeed, it's a handbook on how to engage in the risk insurance space. And predominantly it backs up my thoughts around the business insurance market. It's a complete how to engage in that space. And I think if you haven't seen it, check out the audio book or his book, because it will help position you for that new space. So I know a lot of risk businesses are doing it tough, and there's a lot of question marks over what's going on going forward, and are looking at legitimately different ways to generate income, but, you know, perhaps doing things a little bit differently and working that business insurance space may be an option for you as well. Skills That Succeed, Les.
Cool. And then in terms of my tip, in terms of that, is around kind of figuring out what that ideal business looks like and working backwards from there. And so, is it 80 clients at this fee, which is that turnover with support staff provides X? And then figuring out, okay, so that number of clients. I was listening to a podcast, or even I think it might have been a Zoom call with Seth Godin, who's a marketing expert. He talked about basically if you're trying to niche, create your smallest viable market. So specialized that effectively, so specialized that the market you need is still viable. So it's got the number of clients that you need, but it's so niche and specialized that if anyone's in that space, they're going to come to you. So if it is that you are the business insurance expert within 5Ks of CBD that specialize in businesses in certain manufacturing, all that kind of stuff, that effectively it's a no-brainer that someone will come to you, and then do all your marketing and build your whole systems around that. If that segment is 300 potential clients and you only need 80, whatever it looks like, build your business around that. And that's what I've tried to start to do in the retirement space. And I only see clients face to face because within a 30K area where I am, the market's fairly large. And so just trying to specialize and focus and niche on that area. As long as you've done the first bit, what does that client look like? How many do I need? How many can I get in this area that I need to? And then just niche down and then make sure everything, your systems, your marketing, your processes are built around that. And your alliance partners know that, hey, this is the expert in this area. You'd be silly not to go and see this person.
Yeah.
Brilliant. Well, I think that's all I've got. Julie, is there any last final questions?
Yeah, there is just one last one, and a couple of people have actually asked, could we address it? And it's about when do you present your fees to prospects? In the first meeting, after the first meeting, letter of engagement, when do you do it?
So for us, it's after the first meeting. So we have that initial meeting, collect a heap of information, go away and sort of digest that. We do collect some information before they come in. So we get a snapshot. So we've got a bit of an idea about where they're at. We have a minimum of a 15-minute phone call also before they come in, because we don't really want to waste everybody's time by getting them to come in for a meeting or jump on a Zoom for an hour and a half if we don't think we can help them in the first instance. So yeah, we do that. We've got a fairly good idea about where they might sit before they come in. Then we do a deep dive into what's important to them, uncover a few of the strategies we might be able to help them with in the areas they might need some advice, and then we go away, pull that all together and go back to them with the terms of engagement. Typically, we deliver that on a quick, half an hour Zoom call, and that's when we give them the overall fees.
First meeting is purely getting to know clients, and unless they specifically ask, I'll give them a range. And a lot of the time people are reading the FSG after the first meeting. They may come back and say, is this what you charge me and whatnot? So that's obviously a prompter to talk about it. But typically the fees, once we've got a deep dive on the scenario, they've validated the fact find, we've got it back, we'll build a letter of engagement. It'll be in there around the strategy build. We're very specific around splitting the strategy from the implementation and ongoing engagement, so they understand what it is that we're doing now, and the fact that they can walk away with the strategy document. It's theirs to keep, use as a doorstop, whatever they want to do. Either way, it's a strategy that's tailored to them, and that's why it costs what it does. And then from there, the ongoing engagement captures the rest. It's indicatively flagged in the letter of engagement and obviously solidified in the SOA as well.
Yeah, my model is similar to Jeff's, where effectively we collect some data in the first meeting. We understand what the client's looking for, how we can help them, what we're going to need to do, go back to our pricing calculator, figure what that looks like, and come back to them with a proposal. And we like to do that either on a Zoom call or, because I work with a lot of retirees, they just got the spare time, happy to pop back in and do that. We try and do that within the week. So while they're still thinking about it, they're excited about what we spoke about, this is really what we need, come back in. And typically that's at the start of the meeting. Sometimes that rolls into a bit more of fact finding. Here's some stuff we need while you want to go ahead. But we start that, okay, great. Before we go to the next step, this is what the process is going to look like. Here's the fee to get started. Here's the ongoing fee for the next 12 months after that. And we make that as transparent as possible. In fact, the upfront payment we split across 3 installments, and the first one, like a commitment fee, is charged within a few days after that meeting.
Brilliant. Well, that's it for the questions, and I genuinely want to thank the panel, Jeff, Gavin, and Martin. Thank you so much for taking this time out of your day and to give so much value to everyone watching. Thank you very much. Thanks to Julie, Brett, and Karen as well from the committee, and also I did see Michael Novak make a couple of points on the chat. So good to see the AFA president drop in and watch a really good session. Guys, you've been wonderful. Thank you very much. I'm sure everyone here did get something out of it. Thanks again, and thank you everyone for watching. Have a lovely evening.
Thanks, Matt. See you guys.
Thanks, Matt. Great work. See you guys.
Thanks, guys. That was awesome. Really appreciate it.
Thanks, Michael. Cheers, mate.